Unemployment, bankruptcy, homelessness, a global economic crisis. Should we be optimistic or pessimistic about our global economic recovery? Exploring the impact and seeking solutions, United Nations University presents UNU Conversation Series, The Economic Crisis.
So welcome to this edition of the UNU Conversation Series on the economic crisis, organized in connection with the June 2009 UN Conference on the World Financial and Economic Crisis and its impact on development. I am Jean-Marc Coicaud from the United Nations University. And with us here today, we have Joshua Rosner, who is Managing Director at Graham, Fisher and Company, an independent research consultancy which advises regulators and institutional investors on housing and mortgage finance issues. And Mr. Rosner is here with us today to speak about the role the real estate market has played in the current crisis. So, Mr. Rosner, thank you for being here today and for taking the time to speak with us. And perhaps as a way to start our conversation, a simple question. I mean, how did activities in the housing market contribute to the current crisis?
Well, I think actually, as you know, there's two different crises. They're interrelated. One is the crisis, which is the structural market crisis in the credit markets, which is imbalances in the structural feature of the banks, the banking system, the relationship between investment banking and commercial banking, the originate-to-distributor securitization market, etc. The other crisis, which I think is the crisis that we're really going to focus on more today, is the housing crisis, as it's been called, which is really a crisis less about housing than about consumption, debt, capital flows, and imbalances in the U.S. Consumer balance sheet. And to that end, I think that the housing crisis played a significant role. We essentially created an environment where we believed that home ownership was a social policy goal worth fostering, without actually ever stopping and really asking the question about what home ownership was and what our housing policy goals should be.
So precisely, what is home ownership and what should be these social policies goals applied to home ownership? I mean, what have they been? I mean, what have been the policies which led to the situation in which we are now? Yes.
So, we actually in the mid 1990s saw home ownership rates starting to fall among most first-time homebuyer demographics, the late 20s to early 30s population, and we decided that actually affordability problems were a considerable problem in this economy, as opposed to actually stopping and thinking through and trying to adjust or make changes in policy that would support wage growth to allow affordability to actually be more manageable. We decided that we should actually figure out other ways to achieve higher home ownership rates without actually asking what home ownership is and how to do that safely and soundly. So where we had 20% down payment requirements for most of modern American history, in the mid-1990s we gutted those requirements and we actually reduced down payment requirements to zero. Where we always had appraisers who were really independent valuation experts who were independent of the transaction, appraising the value of a home. We actually compromised the integrity of the appraiser in the mid-90s, also as part of the goal of increasing home ownership rates, where it once upon a time was that you would go to your local bank and you would apply for a mortgage and he would actually look you in the eye and actually assess your credit worthiness and your employment history. We moved all of those functions from the local bank to automated systems. And then actually where the banker used to hold the mortgage, we actually had the mortgage being sold to investors after being pooled. All of these things represented a breakdown in the relationship between borrower and his home, between borrower and society, and between creditor and debtor, and really confused each of those meanings, such that a homeowner used to be someone who started with 20% down, on a monthly basis had a forced savings plan, right? In other words, he would make monthly payments of interest and principal, typically for 30 years, at the end of which he would have the largest retirement asset, for most American families. So to say it more simply, it used to be in America that you would take out a mortgage at about the time that you were starting a family. You would take out a 30-year mortgage. You would pay monthly interest and principal in what was an illiquid instrument. In other words, once your money was paid each month, it really was trapped. That was the value of home ownership and the forced savings plan. That was actually what conferred even the social benefits that are so deeply ingrained and tied to the notion of home ownership. But we think of home ownership in the U.S. as representing more stable neighborhoods, better schools, safer neighborhoods, better ties to one's community. It isn't home ownership we're finding. Actually, this crisis, if it teaches us anything, really should teach us that it was actually that relationship of a forced savings plan, of a constant recommitting every month to this asset, which would become your largest retirement asset.
But initially, so the intention was quite positive. The idea was to enhance the sense of ownership.
Right. Nominally.
Nominally, yes.
Right.
And so you mentioned that one way to really achieve this would have been perhaps to increase wages, salaries, and then we went the other route, that is to say we allowed people to really acquire a house based on no down payment whatsoever. Why is it that we, and in a way, it was the easy route, why is it that we didn't really address the first route, which would have been, let's find ways to think about enhancing, increasing wages so that people are going to be able to really put down down payment?
That would have taken obviously a lot more re-engineering, retooling, investment in infrastructure, investment in our educational system. It wouldn't have been something quite as easily to achieve. And unfortunately, Washington often works on the next election. And so the ability to actually measure any of those changes would not have been as immediate as being able to say, we've increased home ownership rates from 64.5% or so in 1994-95 to 68.5% by the end of the millennium. And so to be able to say we increased home ownership rates that dramatically in such a short period of time is wonderful if no one's actually stopping and asking, would you define home ownership for us?
So precisely, so we follow this rule, that is to say, acquisition of property without having to go through a down payment. So initially, do you think that the people, the decision makers who engineered this, probably not, do you think that they envisioned what could be the consequences of this policy path?
Well, I do think that it was understood. I think that they believed that they would actually be able to extract themselves from the crisis before it ever was recognized.
So what was the extraction plan, if you will?
Well, I don't think there was. I think we've lived in a period where we believe that we can keep shifting from one bubble to the next bubble. And I think that, we were talking before, I think it raises deep questions about the concept of growth. What is optimal growth? What is realistic growth? What is actually equilibrium growth rate? And I think actually if you continue to believe that you can overstimulate to actually extract yourself from one bubble and actually save yourself with another, it doesn't much matter what the bubble is. As you watch, it seems to be that's what we're trying to do once again.
So how do we go from a social policy design for increase of ownership in the 90s to a financial and economic crisis in the US and a financial and economic crisis worldwide? I mean, how do we go from A to B and to C?
So the US housing system actually is unique globally for any number of reasons. One, because of the place that home ownership has in our culture and all of these social values that we tie to it in terms of the neighborhood.
Precisely, what's the cultural philosophy behind ownership in America?
Well, the cultural philosophy in ownership is that homeowners actually are more responsible for their neighborhoods, that they actually have greater ties to their communities, that their school districts and school systems are actually more high achieving, that there's actually a greater sense of responsibility for one's property if you own it. And that has historically been proven out in facts and figures. But again, that was tied to the historic illiquidity of the instrument. Okay, if you take an economics 101 course, historically we think about housing as a unique asset for the consumer. It's the only asset that he holds that's historically been a forced savings plan, right? Which is to say that at about.
And for you, this notion of forced saving plan is very, very important.
It's incredibly important, and actually, it's one of the most important features of this crisis. One that, frankly, we're still not actually talking about. We're still not recognizing is ahead of us. We're still not actually preparing ourselves for, which is the largest generation in American history, the baby boom generation. Is going to be heading towards retirement. They are on the verge of retirement, with the largest number of them retiring over the next decade or so. And many of them have actually extracted equity from what historically, as I said, was the largest savings asset. So that it used to be at about the time you started a family, you put 20% down, you purchased a home, every month you made payments on your 30-year mortgage. At the end of the 30 years, you ripped up your mortgage, and now you could retire with a big part of your net worth
and
in
buy a
liquid
house.
asset. Right, sell it, move to a smaller house, have money to fund your retirement, etc.
So you're saying that this equity was like a social cushion?
Absolutely. And it reduced, therefore, the reliance on the social safety nets.
Yes.
Okay. Unfortunately, because of actually what we've done here, because of the policies that actually created the extraction of equity, which wasn't just the policies. Remember, you can actually have the lower down payment. If you don't have falling interest rates, then people actually aren't going to be able to keep extracting equity by refinancing.
Yes.
Okay, so it was a confluence of events. It was the combination, a toxic combination of new mortgage products, lower down payment requirements, lower underwriting standards, and falling interest rates that allowed people to extract any appreciation or any equity out of the home.
So precisely, how do we go from the housing policy towards the economic and financial crisis in America, and then at the world level? So first of all, from the housing policies to the economic crisis in America, how do we reach this point?
So essentially we end up in a place where Wall Street, actually I would argue that really the crisis actually, the bubble was pierced not in the real economy but in the markets. Why? Because it became that we decided that we could take your mortgage, my mortgage, 50,000 of our mortgages, pool them into a single product, slice them, dice them, rate them, securitize them, that there would be institutional investors who would be interested in buying different levels of risk. Okay? And that actually became what we call the securitization.
But for all these...
And the securitization market functioned until such time as it was clear that the quality of underwriting was such that delinquency and defaults were rising after we had more than a dozen interest rate hikes by the Fed, which signaled the end of the housing market. As that happened, investors became less willing to buy CDOs, collateralized debt obligations. Collateralized debt obligations were the largest purchasers of mortgage-backed securities, which was those 50,000 pools, 50,000 mortgages. And as that happened, it cut off all funding for mortgage origination in the real economy. Okay? As that happened, we saw that investors globally who had been investing in U.S. mortgage assets were actually now going to be impaired, which created a concern on their part that they were going to have liquidity demands placed upon them. Now all of a sudden you started to have panic in the markets. You had investors who were no longer willing to actually trust in the securities that they held because those were actually not cash. They were hard to price, they were hard to value, and it was very, very difficult to look through and see each of our 50,000 mortgages.
But the rating agencies, the companies which really evaluate the value of all these things, I mean, they have to have a responsibility in this situation because they were telling us, telling people investing, well, this is something which has value, while in fact it was very dubious value.
Absolutely. And the rating agencies, look, we've embedded the rating agencies too deeply in regulatory policy. And we actually allowed the rating agencies to be used for things that they were never actually meant to be used for. In other words, for most of the 100 years that S&P and Moody's have existed, they really rated corporate bonds, municipal bonds, sovereign bonds, single issuer bonds. And their models have been generally consistent for most of the past 100 years. When we moved into this world of structured products, which were financially engineered products, where the rating agency was actually part of the design of the product,
you're in trouble.
You're in trouble. Now, you're in trouble for any number of reasons, including the fact that you have a rating agency rating collateral or assets that it has no experience rating. What do I mean there? The subprime mortgage borrower didn't exist ever before in modern history.
Yeah.
We have no empirical evidence as to how he would perform under various macroeconomic environments, and so they had to make assumptions. To add that and have them have to make assumptions about the underlying collateral, and then have to make assumptions about how these products that were newly engineered were going to perform.
But all of this, I mean, led us to really have the housing market becoming a very important part of the economic growth.
Absolutely.
I don't know, I mean, housing market accounted for how much of the national economic growth?
Yeah, no, absolutely. I mean,
and so what does it tell us about, I mean, you know, the US is the most advanced country in terms of, you know, technology, high-tech and so on. I mean, I mean, what does it tell us about the national economy? What does it tell us about the wealth, I mean, the health of the economy when so much of the national growth is based upon the housing market?
I think that's an excellent question. I think actually its answer at this point is self-evident. You know,
but you know, how did we let it happen? Because I mean,
because we did not actually want to address the fundamental underlying reality, which is that we actually had not seen the economy retooled. We hadn't seen proper investment in re-engineering. We were also going through and still are going through this cataclysmic change from what was originally an agricultural society to an industrial society, to post-industrial society. We're seeing changes in labor patterns, and we didn't ever address any of these imbalances, so how could we not have had it happen? We have no coordinated social policy.
In our conversation before before the interview, we talked about the difference between productive investments and non-productive investments, and in a way one could argue that at the very core of this crisis you also have this proliferation or inflation of non-productive investments. So can you, for the audience, tell a bit what is a productive investment and what led us to really focus so much or having the national growth based on non-productive investment, which is a recipe for disaster.
Well, it's a recipe for disaster on the one side. It's a recipe, frankly, for the crisis to go on a lot longer than I think people are considering. So when almost 1 out of every 5 jobs in the state of California during most of this decade were tied in the end back to housing, you have to actually, 1 out of every 5 new jobs was tied to housing. You really have to question where the growth in the economy was coming from. With that, you then have to actually stop and go one step further, which is even now people who are talking about the quote-unquote green shoots, the end of the crisis, the resumption of growth, are talking about things like cyclical demand for automobiles, that there's a natural replacement demand for durable goods, and at some point people will go out and buy a new car because they need a new car. Well, that becomes more difficult also because that was, believe it or not, tied to housing. Why? Because we created this asset liability mismatch on consumer balance sheets where a consumer couldn't fundamentally afford a new car, but because his home price had risen,
it felt it could.
He actually went out and borrowed against the house, took out a loan for a car, okay, and that was terrific as long as home prices kept going up. Well, now that home prices aren't going up, he still has that car. He's not going to be able to very easily go out and get a new one.
Yes.
So it permeated a lot more than even just the unproductive investment in the house. Right.
In your view, what is a productive investment for the audience to explain what it is, and what would be an economy based structurally on productive investment, which seems not to have been the case in the past 10 years?
At the end of the day, look, we've got a workforce that actually probably is not appropriately educated for a lot of the jobs that actually will have to take us into the future, a lot of the service industry jobs. We've got, as we just witnessed in the case of GM and in the case of Chrysler, we've got a lot of employees who are going to actually be displaced. Productive capacity would have actually been to invest in the re-engineering of our educational system, would have been to actually invest in adult education, would have been to invest in building the schools, the hospitals, the roads, the technological infrastructure that would allow more people to telecommute, the investments in green technologies and creating of incentives to actually invest in those type of self-sustaining and
one of the reasons to legitimate the amount of the stimulus package is to say, well, we're going to use this stimulus package as a way to really invest in these productive areas. But why is it, so my question is, why is it that we only wait for the moment of the crisis to really invest in these productive areas? Why is it that we don't do it? Why is it that we haven't done it all along?
Yeah, well, I think unfortunately as a species we're still actually fairly immature. We still have to put our hand on the stove and burn ourselves before we actually learn. And as we were talking about before, it's amazing. We live in a world where we know for the first time in all of human history, we know where everyone on this planet lives. We know what their needs are. We know which of their needs are being met and which aren't. We know what resources we have. And yet we actually wait until the time of crises as opposed to anticipate and participate. And so, of course, time and again, like children, we actually make the same mistakes over without incorporating the lessons of them. Where we end up, I think, from here is actually, probably has to be a greater rethink on the relationship between government and population, right? Even in terms of questions of, the old concerns about capitalism versus socialism, as though they are definitionally opposed and diametrically opposed and can't exist within the same nation state. At some point you have to recognize that there are roles and aspects of each country that actually already and automatically will be representing both sides of that. Even in terms of, you think about the old relationship with the military in the United States, right, with the draft. You would think that one of the things that we could have done in the midst of this crisis would be to say, if you were displaced from your job on an automobile assembly line, we will actually fund your going back to school, to actually work as an engineer for the Army Corps of Engineers for 2 years rebuilding bridges, and then we'll help you find work in an area of need. If you want to go back for an education degree, if you give us 2 years teaching in an inner city school after we pay for the degree, we'll pay for it.
But precisely, and this is, you're saying, these are the things that you think we should be doing precisely, are we at the national level and at the international level, are we using this crisis as an opportunity to somehow reboot the economy on a better footing?
No, unfortunately, I think we're still, frankly, using this crisis. We're treating it as something of embarrassment. I think we're treating it as something to try and hide and pretend isn't and didn't exist. We're trying to actually cover the tracks of people who made mistakes. We're still not even admitting that many of our banks are completely insolvent and there is no recovery for them. We're still hiding the fact, and much of what we focused on and much of the explosion in the U.S. debt over the past 2 years has really been tied to creating the optics of functioning banks.
But why are we keeping our head in the sand?
Well, I think that it would, again, just as it was harder to actually focus on increasing wages, I think that human nature is to actually, unfortunately, at times try and find the easy solution. And the easy solution, I think, is to actually focus on the banks and not actually focus on making the banks look okay, not focus on the imbalances in the real economy.
So precisely looking towards the future, and we're reaching little by little the end of our conversation. What would be the way forward? In our conversation,
well, we talked before, even in terms of the banks.
Yeah, and in terms also of housing prices, you feel that we should let the prices of houses to go.
Yeah, so I think that they're both. I think let's touch on both of those because I think it's sort of important. So we focused on this notion that we have to keep the banks alive so that they can lend. Okay? And yet we're not stopping and asking the question isn't a bank a social utility? And if it is just a social utility, should its rate of return, its economic rate of return, be regulated like a utility, like the electric utility is regulated? because it's there to serve its population. Can we justify saving a banking system that can only survive on the increasing unmanageable indebtedness of its customers?
Yes.
Or should we rethink that banking model?
Because at the moment, this is what's happening.
At the moment, that's all that's happened. And on the other side, in terms of the consumer, as you were asking, or the other way to think about it, actually, the other side of your question
yes.
was more specifically.
Well, I mean, it was about how do we go forward? How do we really? One of the it has been
When
said
we were downstairs,
one of the possibilities would be to let the prices of
right.
housing go down. Why do you think that it would be one way to really use the crisis as an opportunity to move forward on a better footing?
Well, because it's
not going to happen. Is it happening?
No, it's not. Well, I think it is happening, and I think it's happening though against.
But kicking and screaming.
Exactly, against the interest of Washington.
Yes. Mm-hmm.
At the same time, let's stop and remember that it was only 30 years ago that many families in the United States were able to support a home
yes.
on one income.
Yes.
Okay, and so affordability trends in the U.S. are even worse than they actually appeared.
Mm-hmm.
And so the notion of allowing home prices to fall to such a level where perhaps we can have a single-family wage earner support the home might actually put us into a place of more stability, because if the one income earner loses his job, the other can go out and get a job for a while. More importantly, from a social perspective, there's freedoms that come for family structure,
mm-hmm.
right? For having a parent at home. You end up with children who actually have the more stable neighborhood. So let's actually bring it full circle,
mm-hmm.
which is home ownership actually represented stability in its old model.
Mm-hmm.
That's what we gutted, and we gutted it not only from an economic perspective, but from a family unit perspective.
Yes.
That home ownership used to actually, in this country, typically be a family structure where a parent could work, another parent could either work or choose to stay home with the child.
Mm-hmm.
Okay.
So for all these reasons, you are saying in a way prices for houses should go down.
I think prices for houses ultimately, like it or not, will be
They
going
will.
down.
They will, and they are going to go down. How down are they going to go down?
Well, it depends on how quickly and how much the public policy fights it.
Mm-hmm.
We also have to stop and say, is 69% home ownership, is that a sustainable number? It's been not achieved in modern history. It's not been achieved in American history. And frankly, I think given the fact that we have such a significant cultural change in labor that's going to be in front of us as we move into an information age, where there's increasing demands on the labor population to be able to move. Our relationship between rental also needs to be reconsidered, because to own your largest asset in a community where you may not be able to find employment in 5 years is not necessarily the best option.
So what kind of world do you envision 5 years down the road, 10 years down the road?
Well, hopefully social policy will actually evolve to such where we will create incentives to use the home again as an asset to save in. One of the pieces of this crisis that we haven't considered is what we have as a mortgage interest deduction in this country, where it used to be that for the most part you had to put 20% down, and then you were given tax credits for the interest payments that you made. That was great as long as So you would favor the return of the down payment. I would absolutely favor the return of the down payment. I think it's worth actually considering the fact that as opposed to a mortgage interest deduction, which actually creates incentive to have as much debt as you can, we might consider replacing that with an equity tax credit, which actually, the more equity you have in the home, the more of a benefit you have, because that actually would again realign U.S. savings. Okay.
Yeah, as a solution. One of the things that you said earlier is that we are being told in the media by the government that we are reaching we are at the end tail of the crisis. Earlier you told us, well, you don't think so. In fact, we're going to be in a bad situation in 12 months from now. So what will this bad situation look like in 12 months from now?
Well, I think let's distinguish. I think what we've done is we've put scaffolding. We've put some nice facade on the crisis. We've
bit of makeup on the crisis.
Bit of makeup. We've made it. We've stopped the panic. Okay, the crisis that's over is the panic. Okay, the panic in the capital markets. The losses are still actually out there. Banks have not written down their bad assets. You're still seeing a tightening of loans to small and mid-sized businesses. As small and mid-sized businesses have a harder and harder time accessing credit, we're going to see further increases in unemployment. As we see further increases in unemployment, we're going to have more and more mortgage default and foreclosures and consumer bankruptcies. And I don't think that we're fully appreciating the fact that, yes, the economic panic and the structural crisis in that regard is over because of government programs, because the Fed and Treasury have expanded their balance sheets so aggressively and taken on so much of the responsibility of the capital markets on the government, okay, on the public sector.
Yes.
But at some point, we still need to fix the fact that the private sector capital markets are not functioning, which we haven't even begun to repair. And then more importantly, the problems in the real economy, those problems that we were talking about that are related to wage, the problems that we were talking about that are related to credit availability for small businesses. Those are still problems and crises that are really still out there and haven't been addressed. And unfortunately, as this part starts to become more clear, I'd expect in the first quarter of next year, by the first quarter of next year, it'll be much more clear how bad the trends are in those markets. We're going to have to rethink our
and what are the chances for this rethinking, as a way to finish our conversation? What are the chances for this rethinking to take place? Well, you seem to be quite pessimistic.
I am quite pessimistic. Look, we had an opportunity to have sweeping regulatory reforms in the financial system, bold and sweeping regulatory reforms. And I think even there we're choosing to actually try and please everyone, which is noble. It's a noble intent. At some point, there's the old saying that you shouldn't let the
But are we trying to please the taxpayers? Not necessarily.
No, but there's this old saying that you shouldn't let the perfect be the enemy of the possible.
Yes.
At some point, you do have to let the perfect be the enemy of the possible.
And that's the job of a good regulator.
And that's
to find, and it's a tough one.
Absolutely.
To find the balance, not only to handle the crises of the present, but also the one which are likely to unfold if we don't really find this right balance.
But again, until you actually have a consideration and a conception of definitions, which is, again, this whole crisis is really a crisis of definition, of standards. Right? So people talk about the complexity of the structured securities, the actual investment instruments that were at the root of the CDOs, the mortgage-backed securities that were part of the root of the crisis. And they talk about the complexity. The complexity wasn't in the structure. The complexity was that every single company that issued these securities had different definitions for the same thing. So we don't in this country still, to this day, 2 years into the worst financial crisis of the past almost 100 years, we still don't have a single definition of delinquency and default in this country.
And that would be part of the job of regulators to really, outline what would be, the standard, the right definition on which to agree upon.
We still don't have a definition of subprime. We all talk about a subprime crisis. I don't think anyone I know knows what subprime is. Is subprime defined by the borrower? Is it defined by the mortgage product? I know that it was once defined by a lower credit quality borrower, but then as actually we saw the creation of new mortgage products in 2002, 2003, 2004, 2005, it became increasingly considered as part of the product. But could prime borrowers take subprime mortgages? Could subprime borrowers take prime mortgages? Well, of course. So we need to create standards of definition, because language is ultimately a compromise. It's the only thing that we have in common.
In essence, you are saying that this lack of definitional clarity is an expression of the regulatory mess in which we are, and led to the production of this economic mess.
Absolutely.
Mr. Rosner, thank you for your time. Thank you for this great conversation and for your insights. I hope you will come back at one point. We have reached the end of this conversation, which dealt with housing issues and regulation or regulatory issues. I am Jean-Marc Coicaud from the United Nations University, and I thank you for watching.